Chapter 5 discussed inventories and how we would handle the journal entries to buy inventory and then how we would handle it after we sell the inventory. Chapter 6 deals with valuing the inventory as well as cost of goods sold. There are several inventory valuation methods that a company can use. One's called specific identification. Another is FIFO, first in, first out. Another is LIFO, last in, first out. And finally, the fourth method is the weighted average method. Remember, in Chapter 5, we had to come up with a way to identify the cost of the good that we sold. Well, this chapter deals with 4 ways we can do that. First is called the specific identification inventory cost method. This one's really simple, but it's not used that often. If we sell an item, we would specifically identify the cost of that item. Of course, this is difficult to do if I have a large warehouse of items. This would work especially well, though, let's say with a used car lot, something like that, where I can easily identify the cost of the item. Second method is called FIFO, first in, first out. Literally, as items come into the warehouse, I record the cost. And as items go out through a sale, I would record the cost of the sale. The FIFO method basically says the first ones in the door are assumed to be the first ones out the door. Doesn't necessarily mean that's physically what happens, but that's the method that we will use. Grocery store shelves are a good example of that. Next is the LIFO method, which says it's the last ones in the door are the first ones out. Once again, not necessarily the physical movement of the goods, but this is the method that we use for bookkeeping purposes. And the final method is the weighted average cost, and we simply take all of our inventory inputs, that would be purchases, and outputs, that would be sales, and we come up with a mathematical calculation. We'll cover this in some detail in the chapter. GAAP says I can choose any method I like, whichever one basically fits the model for my particular business and more accurately reflects the costs and the revenues. Typically, in a period of rising prices, the LIFO method will generate the least amount of gross profit. This is sometimes attractive from a tax point of view, because the lower my profits, the lower my tax bill. Finally, the merchandise inventory shows up on the balance sheet as a current asset, and of course the cost of goods sold shows up on the income statement as a cost of goods sold.